Welcome to this lecture on classical macroeconomics, the self-corrective mechanism, and the quantity theory of money. Here, we're really going to focus on the self-corrective mechanism, and we're going to see that the price system really adjusts the macroeconomy to keep the macroeconomy at an efficient state. When it comes to the self-corrective mechanism, part of the classical argument should be recognized that we don't even actually need self-correction that much in the first place. The classical argument is that, hey, with wealth growing, sometimes from international trade growing the economy as we go, that the macroeconomy, the ups and downs, sure they might happen, but they're not as important as other economists are going to make them seem in the future. Classical economists kind of downplay the ups and downs in the short run. And one of the ways that they do this is they say that the economy doesn't need that much correction in the first place because aggregate demand is relatively stable. They're going to say that there's not a lot of random fluctuations because C is a relatively large component of our aggregate demand, C plus I plus G plus NX. And C is relatively stable. So we won't have these wild changes in output and demand. In essence, the economy seems to kind of keep itself on track by not really ever getting off track in the first place. Consumption demand is relatively stable. But nonetheless, even if we get off track in the short run, we still could have a self-corrective mechanism. And that's what we're going to discuss with the classical economists. How does the economy ever get back on track if it is ever derailed? All right, so this is really part 2 of our classical macroeconomics lecture series on the self-corrective mechanism and the quantity theory of money, where we're trying to discuss these price adjustments and how classical macro sees them as impacting the macroeconomy. What we're going to discuss now is really the long-run impact on the aggregate supply, aggregate demand curve of getting off track of our target, off track of our long-run aggregate supply, full employment, potential output, kind of benchmark outcome for the macroeconomy. We're off the trend line of the business cycle. We're either in an economic boom or in a contractionary recession. And so we want to see, well, what happens in classical macro to move us back towards that trend line or back towards the full employment, potential output, long run aggregate supply curve on the aggregate supply, aggregate demand model. So we're seeing what happens in the long run once everything has adjusted. And the classical economists, we're going to say, have this self-corrective mechanism, that this long-run phenomena, this happens and the economy adjusts and we get back on track. Now, for the self-corrective mechanism, it doesn't really matter why the economy ever gets off track. What we can see here is that the economy is on track. We are at our potential output, and we are at the long-run aggregate supply curve with our equilibrium. So the short-run aggregate supply curve crosses the aggregate demand right at our long-run aggregate supply curve. This is what we want. But what we could end up seeing is we could see aggregate demand drop. And if aggregate demand drops, our new equilibrium is this point here at an output that is less than this 5,000. And so that would be a bad outcome. We would be in a recession. We would be below the trend line on our business cycle. We don't want this to happen, but we're asking, okay, well, what happens in the long run if we're at this point? What happens to our economy? And what we're going to see is, hey, we're below our potential output. And it's not really going to matter if this is what happens or if the short-run aggregate supply curve shifts back and our equilibrium point is here. In both cases, we will get the same kind of response. If we are to the left of the long-run aggregate supply curve, if we're anywhere over here, we're going to get the same kind of response. Now, it does matter for the macroeconomy whether or not we started with a negative move of the short-run aggregate supply or the negative move of the aggregate demand in terms of price levels and what's going on in the economy. But in terms of the self-corrective mechanism or what happens in the long run, the same thing is going to happen no matter what if we are on this side of our long-run aggregate supply curve. And then we tell the same exact story for, well, what happens if our short-run aggregate supply curve moves out, right? And now our equilibrium is at this point here, right? What if we are beyond our potential output and our full employment level of production? Or what happens if our aggregate demand curve shifts out and we get aggregate demand 2 here? And now our equilibrium is at this point, which means our output is beyond our benchmark output here of 5,000, right? In both those cases, if we just move anywhere on the right side of this long run aggregate supply curve, we're going to see the same kind of response. Now, again, it does matter for the macroeconomy how we started this, but what we're going to do in this explanation is just showcase, well, what happens when we are either to the left of this long run aggregate supply curve benchmark, right? If we're over here and we're in recession, we're below our trend line in the business cycle, or if we are to the right and we are above the trend line in the business cycle and we are past our level of potential output. In both cases, the response of the economy will be the same, regardless of the kind of start of the fluctuation being different. So here we can see a case where we are to the right. Doesn't matter if short-run aggregate supply curve moved out or aggregate demand moved out. No matter what, if we are in this situation where we are beyond our potential output, where our production is to the right of our potential output, where we're to the right of that long-run aggregate supply curve, what's going to happen in this scenario is that real resource prices will rise. So we are booming in an economy, right? We are producing beyond our potential output. This isn't actually sustainable. And so what happens is we have strong demand and low unemployment. Imagine that you're a college student and you graduate into a booming economy. There is strong demand where firms are trying to hire more and more workers in, and there's very low unemployment. So there's not a lot of people out there looking for a job that don't have a job. What do you think you would do in terms of your wage negotiation strategy? Well, you're probably going to get hired in by 2, 3, maybe 4 different firms as you're going through and interviewing, and they're all going to make you an offer. And in that kind of scenario where you know a lot of different firms want you and you know times are booming, you're going to like ask for stop options and a nice parking spot and a real high salary, right? The cost of hiring you in is going to get higher and higher and higher. The real resource price is rising. One of the biggest resource prices is the price of labor, or the wage rate. So this strong demand for capital goods in this tight labor market results in these higher and higher and higher resource prices. The wage rate is really going to increase. And as resource prices rise, you should note that this is one of the main drivers that shifts the short-run aggregate supply curve. So when you learned the shifts of the short-run aggregate supply curve, one of the things that you saw was that resource prices can shift the short-run aggregate supply curve. And as resource prices rise, the short-run aggregate supply curve also rises. And so what we will see is that in the long run, once these higher resource prices, once these higher wages are taken into consideration and all of this, it moves the short-run aggregate supply curve back, and we eventually, with enough adjustment, would shift back to our full employment level of output, our long-run aggregate supply curve. So we would have this self-correction of the short-run aggregate supply curve. So in the short run, output can exceed the economy's full employment capacity, but eventually prices adjust. The economy self-corrects, and we get back to our long-run aggregate supply curve. So the long-run change here is if we are anywhere to the right of our long-run aggregate supply curve, if we're anywhere over here, then what we're going to see is short-run aggregate supply curve is going to increase and pull us back to the long-run aggregate supply curve. Now, what if we are in the opposite situation? We are somewhere to the left of the long-run aggregate supply curve. Well, in that scenario, whether it was caused by a negative supply shock to the short-run aggregate supply curve or aggregate demand falling, doesn't really matter. We have an equilibrium point that is to the left of that long-run aggregate supply curve. And what will happen in this scenario is we can once again look at our resource prices and we can say, okay, well, there's weak demand for the labor market and high unemployment. We have an unemployment rate that's greater than the natural rate. There's lots of unemployment out there. Firms aren't producing a whole bunch, and it's not like they're exactly looking to just hire a bunch of people at the old costs or anything like that. And so imagine you're a college graduate going out into the workforce in this scenario where you're in the middle of a really rough recession, no one's really hiring. Are you going to end up with 3, 4, 5 different offers from different firms? Probably not. It probably is not going to be the case. You're probably sitting there desperate just to get any kind of offer for any kind of job. And quite frankly, there's lots of other people out there who are unemployed who are willing to take similar positions to what you could get. And so when you're offered a job, you are in a very weak position and you just take anything you can get. You don't negotiate for the nice parking spot or stock options. You don't negotiate for the higher salary. In fact, you probably are willing to take a lower salary than other people who are already working at that current position. And so what happens in this situation when we are to the left, when we are over here, when we are below our potential output, is that we end up with lower wages, that wages will be going down. They will start to decrease. And your shifter of the short-run aggregate supply, the idea of resource prices, in this case with lower resource prices or lower wage rates, because wages are the price for, or the resource price for labor, very important resource price is the labor market. With lower resource prices, what happens to your short-run aggregate supply curve? With lower resource prices, your short-run aggregate supply curve shifts out. And so an increase in short-run aggregate supply as resource prices drop. And this will continue to happen and continue to happen until we get to a point where the aggregate demand crosses the short-run aggregate supply back at our long-run aggregate supply curve. So the drop in the resource price adjusts our short-run aggregate supply curve, and it adjusts the macroeconomy back to full employment. In the long run, the price system adjusts our behavior such that we get back to our full employment level of output. So in this case, when we are to the left of our long-run aggregate supply curve, when we are in a recession or when we're having a tough time economically, then what happens is wages, they fall, right? So if we are over here, if we are anywhere on this side of that long-run aggregate supply curve, then wages are going to be reduced. And when wages reduce, the short-run aggregate supply curve shifts out. So in this case, what we can see is that it's all about the price system, the adjustments of the market economy, changing the prices, and those changes in the prices change our macroeconomic outcomes and get us back to full employment in the long run. Now, that is the standard depiction of what happens to the aggregate supply, aggregate demand model when it gets out of whack in the long run. But there are some kind of special cases that you should at least take note of. Now, we will keep the standard case as our standard case, but we just kind of want to mental note that, hey, other things can happen here and there, but we want to really focus on the normal case. But let's just talk real quickly about some special cases. It could be that what we had was an original equilibrium at AD0, short-run aggregate supply 1, and the long-run aggregate supply. And all that happened was we had this drop in consumer confidence. And so C and I just drop way down, and we have this short-term recession. But then before we get to a point where wages drop and the short-run aggregate supply curve shifts out, like our normal self-corrective mechanism, our normal long-run story, before that can occur, consumer confidence could be restored and consumption and investment could raise right back up to where it used to be. And we could end up at not AD0, but AD2. We could just shift back to where we were. So aggregate demand might just bounce back from this kind of drop in the economy in this case. Another thing that could happen is we could have a situation where we have free banking or a competitive money supply. And what happens in that world, which isn't really a scenario that exists in the real world right now, at least not in major economies, is we could have a scenario where interest rates also help us adjust our macroeconomy. So if we are at a point in our equilibrium that is below our long-run aggregate supply benchmark, if we're anywhere to the left of this area, right? So if our equilibrium is anywhere in this box, then what we could see is that interest rates could have an effect on our macroeconomy as well by shifting around our aggregate demand curve. Right? And so if we are anywhere to the left of long run aggregate supply, what we would likely see is a drop in real interest rates because of weak demand for investment. So if aggregate demand is less than full employment, weak demand for investment lowers real interest rates, right? So you can think of your loanable funds market, and you have supply and demand, and if there is weak demand for investment, you have D2. What has happened to that interest rate? Well, it has decreased, right? And with lower interest rates, you should note that your shifters of your aggregate demand curve, one of them is interest rates. And with lower interest rates, what happens? We get an increase in aggregate demand. So if the macroeconomy allows for this competitive money supply situation where we have free banking, and we don't have a central bank that is just controlling the interest rates, what we could see in this kind of special case is this story where aggregate demand also bounces back out. And so what we could get is once we are at this equilibrium where we are struggling, it could be that in that scenario, the price system adjusts us back by shifting aggregate demand out, not the short-run aggregate supply. And this would be a situation where the interest rates, they fall, and they fall quite quickly to boost aggregate demand back out to increase these large-scale consumption purchases and especially levels of investment. Now, in reality, if we were in this situation, what we would likely see is some short-run aggregate supply response from lower resource prices, lower wages, and then also some increase in aggregate demand from the interest rate dropping, and we would get back to full employment equilibria from adjustments from both, right? And it would depend on which one was stronger. If short-run aggregate supply curve was stronger, we would end up with a slightly lower price level than what we were at in the recessionary equilibria. And if the aggregate demand response was a little stronger, we would end up with a slightly higher price level than the recessionary equilibria back there at AD1 and short-run aggregate supply 1, right? But this is only a special case. This is just kind of a theoretical special case in particular here, right? We can see that this story only exists in a world where we have competitive banking. But what this does is this adds to our story of what could happen in a free market economy. This special case suggests that even without a central bank, there's some reason to believe that the economy would have some self-corrective capabilities that currently require managed or controlled correction. Nonetheless, the realities of the central banks in existence in the world today and the mainstream approach to the aggregate supply, aggregate demand model's long-run adjustments is to showcase only the short-run aggregate supply curve adjustments. So this is just our very special case of the aggregate demand bouncing back, or a situation where we'd have free banking and aggregate demand can also shift us out, right? So we want to keep in mind these are just special cases. The standard approach, what we really want to focus on with the self-corrective mechanism is that if we end up with an equilibrium where we're in recession, that resource prices will drop and short-run aggregate supply will shift us back out. And if we are in a scenario where our economy is overheating, if we're to the right of our long-run aggregate supply curve, resource prices will rise and short-run aggregate supply curve will thus move back and get us back to our long-run aggregate supply equilibria, our potential output, right? So these are just special cases for us to kind of keep in the background. So that is the classical macroeconomist self-corrective mechanism. We saw that the classical economists are going to argue that we don't get off track all that often because consumption is relatively stable. That's an empirical reality. We also discussed what happens if we do get off track. If our economy goes into a recession, then what happens is resource prices drop and the short-run aggregate supply curve moves out to get us back to full employment. And if our economy is overheating, resource prices rise, and that pulls the short-run aggregate supply curve back and gets us back to full employment. The economy self-corrects. To continue on in this lecture series, click on the video right over here.